Well, let's get started. It's February 10th, it's 10:12. We'll call the regular meeting of the Board of Investments to order. And what did I do?
The 11th.
It is? Okay, February 11th. Start with roll call, please.
Carl England,
Here.
Mark Nodig, Jack Crawford,
Here.
Terry Covey,
Here.
Bruce Nelson,
Here.
Diane Gladnell,
She's here, but she's not
Maggie Peterson, here, Jeff Greenfield,
here.
Jim Edwards,
Here.
Senator Thomas,
Here.
and Representative Hamilton.
Here. Okay. Please remember that we're video and audio recording the meeting. And are there any public comments on issues within the board's jurisdiction? Seeing none, we have some minutes from the November meeting. Everyone had a chance to look at them. Any additions or corrections? If not, is there a motion to approve them?
So moved.
Okay, is there a second?
Second.
Any discussion? If not, all in favor say aye.
Aye.
Any opposed? None? You ready, Maggie, for audit committee?
Yeah.
Okay.
Okay, we had a long meeting today. So I'm going to keep this as brief as I can, because I'm sure you all don't want to hear every single little detail. So, Terry said yes. So the first thing we did, we had a presentation, several of them by Julie. She talked about the status of our FY19 audit. It's nice to know that on December 20th, 2019, Legislative Audit Division issued an unmodified audit opinion with no recommendations for both the Unified Investment Program and the Enterprise Program statements. Yay. We held an exit interview on January 3rd. I was on via telephone because I was in Vegas watching a hockey game. It was the shortest audit call I've ever been on in my life, just so you know. It was great, Dan, and all of our accounting staff did an amazing job, so thank you very much. The Board of Investments audit should be presented to the Legislative Audit Committee either on April 27th or 28th, or maybe both, I don't know. Should be a pretty brief meeting for Executive Director Villa. The Legislative Audit Division has posted our audit to their website. It's just for information. Our next year's FY20 Legislative Audit Entrance Conference will be held in March or April. More to come when that happens. Julie talked about our stock audit. There are two parts to that. The first part is that the WIFLE should be on site in April to begin their planning and preliminary testing for the next go-round. They also provided us with a management letter, and that management letter had some recommendations, comments and recommendations that really didn't impact anything that they provided to us in the past, but they had some great recommendations surrounding things like physical security, so you'll notice that we've already started implementing some of these. We have our new badges to get in the building. Adherence to investment policies, other policies in general, which would be things like ACH, wire transaction processing, shredding procedures, job descriptions, disaster recovery tokens, and meeting documentation. So as we go through and make decisions with regard to any of those items, I'll present them. Let's see. Our annual report was posted to the website before the deadline of December 31st. So again, good job, accounting staff. Let's see. The next thing is that Julie submitted some proposals for some policy revisions. They are with regard to the governing policy. I can't think that there were any huge changes other than, I think the major change was a couple of them for code of ethics that we would all find, it would be specific that we would also do forms every year. There was language in there with regard to in situations where the executive director and the chief investment officer, there were issues that it was a pause clause, I call it, so that's what I put in my notes. So things might be put on hold temporarily, and until they get some board input. So, is there anything else that the board can, oh, the other thing, the final thing was with regard to our state streets banks credit rating. They used a more generic term, using this nationally recognized statistical rating organization as a standard. So, is there anything else that I'm missing? Okay, so anyhow, the committee recommended approval of all of the governance policy changes with regard to the general policy, the code of ethics, and the custodial bank policy, and I would move for approval.
Second.
Second, any further discussion? If not, all in favor say aye.
Aye.
Any opposed? None. Anything else, Maggie?
That's it, thank you.
Okay, Terry, you're up for HR.
HR, and first of all, I want to thank the board and the staff for participating in this process. My first motion is that the board move to hire John Putnam as Chief Investment Officer per the terms and conditions of the attached contract.
All right, any discussion? Not, all in favor say aye.
Oh, and second, I'll second.
Oh, is there a second? I'm
I'll
sorry.
second.
Okay, now is there any discussion? If not, all in favor say aye.
Aye.
Any opposed? No.
Second motion, I move to hire Randy Moffett as Deputy Chief Investment Officer per the terms and conditions of the attached supplemental employment contract.
I would second that.
Okay, any further discussion from anyone? If not, all in favor say aye.
Aye.
Any opposed? Anything further?
That's it. Thank you.
I want to say 3 or 4 things if I could. First of all, I echo Terry's compliments to the staff on behalf of the board for helping. You didn't make it any easier, but you did provide us some great information. Second, it is not a coincidence that our finalists were both in-house candidates. When I started on this board, all of our investments and all of our people were kept in very tight silos. To say that you were discouraged from leaving the silo would be to put it mildly, I think. And over the years, I think we've tried to make that, change that, and I think we largely have. And I think that the fact that we had such a difficult time deciding between 2 very qualified in-house applicants shows that you are operating as a team, and we really appreciate that. And then last but not least, I just, on behalf of the board, Terry, thank you for running a tight ship. So. All right, anything else from Human Resources? The Loan Committee.
Okay, the loan committee met today. We have to have the board approve a couple updates on our loan package forms, and so we approved Montana Board of Investments Commercial Loan Package, the Board of Investments Infrastructure Loan Package, and also the Board of Investments Investment Loan Value Added Loan Package, all 3. Mostly just updating things and keeping them current with what we're actually doing. And I think most all the board was there. And so I would like to make a motion to the full board to approve those 3 loan packages with their updates.
Okay, is there a second?
Second.
Is there any discussion? If not, all in favor say aye.
Aye.
Any opposed? None? Okay.
Also, we looked at some things. The Montana Craft Malt Company in Butte received a loan from Board of Investments through Trail West Bank, who's a new bank that's on our approved list. Board of Investments loan is $7 million. That's a fully guaranteed loan by the federal government. And also more of a notice to let the public know what we're doing. I want to make that notice that we did formally approve that by staff and reviewed it by loan committee without approval. Is there any questions on that? Okay. If not, then the loan committee did approve a couple other
Available command, press star 1. There is one other caller on the call. Dana Chapman has joined the conference.
Mark Melnick.
Has joined the conference.
Okay, Mark, we're into the loan committee report, then Jack's just about done, right?
on loan, because I know it's lunchtime.
Yeah.
So we did approve an intercap loan to Sun Prairie Village in Great Falls. Interim financing for their water and sewer district. That was a loan of $1,335,000. So that can be approved, I think, just by loan committee. And then we have a new borrower to our organization. It's the Department of Corrections. And so the Department of Corrections is financing a building at the Montana State Prison. They call it the Cook Chill Building, otherwise known as the food factory at the prison. And so the loan committee looked at that and approved a loan of $2,750,000. Again, that's not big enough to go to the full board, but I wanted you to know that we did that loan also. Is there any questions on any of our loans?
If not, are you done?
I'm done.
All right. Comments from TRS and PERS. Jeff, you want to start?
Teachers retirement system last met on December 6th. We had an update and discussion on our information system, which we've been updating for 3+ years. Call that M-Trust. And we're at a point where we've completed all of the work, changing over to a system that actually can be supported by more than one individual in the U.S. And it's actually functional. We have some online forms that are working very well, and we're going to make a few additions of online forms for members in the near future at a small additional cost, but we actually came in under budget by a little bit less than what this edition is going to be. So a little bit more work, making it more functional for our members to be able to do things like change the individual who is the recipient of your benefits, your beneficiary, to change an address form online, to do other things that make it quite easy to make those changes even if you aren't living in Helena, and you don't have to make that phone call. So it's been a good process. We also completed our long-range strategic plan updates. We do that regularly. We're working on remodeling the office space that we vacated, so it is able to be either rented or sold, hopefully the latter. But it is on the footprint of the Capitol complex, so that's a different issue all by itself. The second half of that day was actually set aside to meet with a member who has had some issues, and we've been through Supreme Court 3 different times with this individual. And the morning of the meeting called and said he wasn't coming, so that was the end of the meeting.
There we go. All right. Anything else?
That's it.
Maggie?
Okay, the Ampera board met on December 12th. We have quite a few things on our agenda. First off, we have 3 members. We have 2 members that had their last meeting on December 10th. That'd be Marty Tuttle and Julie McKenna. And the meeting that is being held this Thursday will have a 3rd member at their last meeting. So we have 3 slots we need to fill.
How big is your board?
7. Which is, it's going to be interesting. So we're hoping that the governor gets some appointees. We had 2 cities, the city of White Sulphur Springs and the city of Plentywood, join the deferred compensation 457 plan and signed adoption agreements. And we had an audit committee. It's kind of interesting, these audit committee meetings have the same issues coming up over and over and over, and makes me wonder how we're doing sometimes on educating our employers as to what their responsibilities are. But anyhow, we had 22 employers that were audited. 7 of them had no issues, no findings. 15 of them had several, 3 different issues, major issues. The biggest one is probably also the one that costs the plan the most money, which would be not offering optional retirement membership to those employees who aren't required to participate in PERS. And there were 49 employees that were impacted by that. And in some cases where those people are part-time, they get a full-time job later, and then they elect PERS, they can go say, you never gave me an option, and then all of a sudden you have to pay all those back contributions. So there could be substantial costs. There were some late fees for 7 employers, and there were reporting errors, which are pretty minor for 4 different employers. Never a dull moment with audit meetings, of course. I love that stuff. The other thing is we had some...
Never a dull moment. Oof.
We had 3 different litigation issues. One you're going to hear about this afternoon. It's open meeting, right? No, it's not? Okay. So you read about it in the paper, I'm sure. Peer review. The other thing, we had 2 issues. One was with a judge, and that's ongoing. It's been ongoing for a while. And we have another issue with a gentleman who has been battling an issue with PERS with regard to taxing disability benefits. So hopefully there's an end in sight. It's been going on as long as I've been on that board, so who knows what could happen. There could be a substantial cost though if it's not resolved soon. So. Let me see. An update on our IT system. We are making progress. We have this really fun chart that the guy makes with yellow lights, green lights, and red lights. You guys will probably use that as whatever you do too, but we're mostly not red anymore, which is really a huge plus. The system is starting to work as we hoped, and they're working out all of the kinks. So hopefully in another meeting down the line, I can say they're all green, but
Okay.
right now they're not.
All right. I want to bet. Comments from legislative liaison, Senator Thomas?
One thing I'd add is that the update we got last week, I think, from the legislative fiscal division on revenues for the state remains very strong and solid. I don't have a number to throw you, but I can share a chart if you wanted at some point, individually or otherwise. But revenues are remaining strong, which is just simply an indication of the economy of the state as well.
Okay. Representative Hamilton?
Thank you, Mr. Chair. I think that numbers were 80 million above estimates at the moment. I'm not 100% sure on that, so don't quote me. But I'll switch gears to something I'm a little bit more sure about, and that is what we did during legislative week. This was something that I was part of helping to arrange. Presentation on Wednesday morning, and we encouraged all legislators to come to that to talk about sort of a high-level view of pensions and different perspectives that are out there in the world these days on pensions. Pretty high-level view, and I was quite impressed with how many people were interested. A lot of people showed up, many more than we expected. I think we were expecting 10, and we probably had more like 30 or 40. In the afternoon, then, on that same day, which is Wednesday of legislative week, there was presentations made to the Legislative Finance Council and SABA, which is the interim committee responsible for sort of supervision of the pensions. And those presentations started with Director Villa, who reviewed the processes and results for the Montana Board of Investment. And then we had 3 other presenters who did a little bit deeper dive in the morning session on risk assessment. That would be Kavanaugh McDonald, who's the pension plan's actuary, Chiron, who actually at one point had been our actuary and back in the early 00s, I think. And then Pew Charitable Trust had a representative there as well. What is going to come out of that, or what had already been planned to come out of that anyway, was we will be getting shortly, we think in February, the pension boards will be getting a risk assessment done by Kavanaugh McDonald, which is under the new accounting standard rules. They're supposed to do something like that. They've agreed to adapt it slightly to some of the concerns that we had, and so we'll see what comes out of that. And then Pew is also going to do their version of a risk assessment, which is slightly different than what Kavanaugh McDonald will probably do. HB 715 is a study which is, you could call it a tax study, but it's a little bit broader than that. I'm the chair of one of the subcommittees there that is looking at all of the interactions, major interactions between state and local government, pensions being a big one, entitlement share, infrastructure, public defender's office, and so forth. And so we'll fold the information that comes from the risk assessment probably into that committee, which will then go back to the main committee now called MARA, Modernization and Risk Analysis, which will sort of take all of the information from the subcommittees and take a broader view at our budget and our taxing system. So that's what happened during legislative week.
Okay, thank you. You want to go or you want to break? Let's break and come back.
Okay.
Let's do that.
Okay.
All right? All right.
Mark, I'm just gonna mute you, Mark, okay? That way you don't have to. I'm ready.
All right, should we get started again? Executive Director report.
All right, Mr. Chairman, you have my report. I want to first thank both your staff as well as RVK. Under tab 10, Jim will be presenting in response to Mark's question from November about the liquidity analysis. We've got a full report in there for you. Jim will walk through it later. The rest of it's all pretty pro forma. I also included the presentation that I gave to the Joint Finance and State Administration and Veterans Affairs Committee. Yep. One of the elements of that I'd like Jim to just walk through very quickly is the difference between the expected return that was adopted with or the capital market assumptions.
History, the conference.
And with that, Mark Nonig will be leading that effort.
Right.
Thank you, Mark, we really appreciate it.
So Jim's going to walk through why there is a difference between the expected returns that you saw in the asset allocation discussion and the actuarially required returns that we talk about on such a regular basis, because they are apples and oranges. So I'll turn it over to Jim for just a moment if I could, Mr. Chairman.
Jim,
A little bit impromptu, but
better you than Mark, right?
depends on your point of view, Mr. Chair. So there's a lot of confusion about the actuary's estimate of the assumed rate of return and what comes out of any particular asset allocation study that we might do this year, next year, after that. I would say it would be a statistical oddity if they turned out to be the same. I've never actually seen them be the same, not that I can recall. And the reason is that they have different time horizons. The actuary is trying to ask the question over a much longer period of time than we look at things. What is the appropriate contribution level that should be put into the plan to make sure that the plan amortizes? And so what I say about the assumed rate of return is that its main purpose is to set contributions in a way that presumably both amortizes, meets the normal cost of the plan, amortizes any unfunded liability over a reasonable period, whatever the plan assumptions or documents or requirements are in place. And so it's got a completely different time horizon and purpose in setting it. The assumed rate or the expected rate of return that comes out of an asset allocation study is largely driven by a shorter term horizon, albeit still a strategic one, not like a year or two, but 10 years plus. But that's way shorter than actuaries normally have. And by the way, one other point I'd make about the way we view what actuaries are trying to do is not only are they trying to do everything that I said, but they're trying to spread the costs of public service appropriately over the generations that benefit from them, right? Because if they underestimate contributions, then what they're doing is they're essentially taking the costs of today's public service and pushing it forward onto the next generation. If they have contributions that are far too high, they're essentially making today's taxpayers pay more to the benefit of the future. And so the actuary's got a tough job, but it's a different job than what we do. What we do is we're trying to address the question, and by the way, the actuary is in no way responsible for the issue of that is so prevalent at this table, which is the prudent protection of the assets. So now let's switch over to asset allocation. Different time frame, strategic in length, but much shorter than actuaries typically. Number one. Number two is that it has no connection. We're not trying to do anything with contributions. We're trying to essentially devise, according to the prudent investor rule, which is discussed in Dan's presentation, by the way, to get a diversified portfolio that, given the uncertainty of what parts of the capital markets may perform well or poorly, will allow the fund to reap as much of the benefit of what the capital markets have to offer as possible. We know that asset allocation is the primary determinant of the return of a fund over a long period of time, and it is also the primary determinant of the risk of the fund. And by the way, it's also the primary determinant of the investment fees that are paid. That's why asset allocation is so important. So there are times, and it also, the risk, when I follow along with the risk assessment that you make as fiduciaries also has to incorporate your obligation to protect the corpus of the assets that has been built up to date, to pay those functions. Again, the actuary is not directly interested in that part because that obligation lies at this table. And so, so they're not the same thing. And so there are times when you may, either because your sense of risk to the assets that you're meant to protect, cause you to have a more conservative portfolio, which has a lower expected return for the moment. And it may be below the actuarially required return that the actuary is setting to drive contributions into the plan over several generations. But there are also other times, and we see this rarely because we've lived in a world in which the assumed rate of return has been coming down on a fairly steady basis. That there may be times when you say, no, this is a time when we feel comfortable taking risk, and our expected return may be actually higher than the assumed rate of return, which again is serving a different purpose. So in our opinion, you should never assume that those things have to, at any given point in time, be precisely the same. Now, over a very long period of time, they should bear a resemblance to one another. But we're talking somewhere between the asset allocation time frame and the actuary's time frame. Is that helpful, man?
Perfect. Thank you.
Actually, before you go, I have a question, and that is, I'm a little confused on the time frame of RBK's capital market expectation. Seems like, I think maybe Mark and Becky have talked about it in the past, they've talked about it as 10 years plus, 10 to 20. I know that our actuary in the last experience study referred to it as a 30-year estimate. Never really the boundaries of the capital market expectation for RBK.
Yeah, it used to be somewhat shorter. We used to say 10 years. But as we've developed our methodologies, what we have used more and more something called regression to the mean. And so one of the methods, we use multiple methods to try to create these estimates. And I don't want to call them guesses because they, we publish a 90-page paper saying exactly how we got there. but they are estimates of the future. We will often look and say, by historical standards and by relative value standards, something is really high. And for example, right now, US equity is really high, that's widely recognized. So then the question becomes, if we assume that there's a regression toward more equal valuations among competing asset classes, how long will that take? And the gap is big enough now that it extends beyond 10 years if you assume that it takes place very gradually. But we don't know how fast regression to the mean will take place. We only know that in market history, it tends to happen. Sometimes it takes a long time. For example, US equities have outstripped foreign equities for a long period of time, better than 10 years. So we now say 10 plus, and it could extend to 20 because we have some asset classes where our regression to the mean may require that long a time to take place. Is that helpful? It is a squishy issue, but in all cases that I've encountered, our time horizon is always shorter than the actuaries. And actuaries differ in terms of what they say as well. Sometimes they say 30, but some I've heard say 50. So, is that?
So it sounds like what you're saying is that very far outside would be 20 years. Is that fair to say?
Yes, I think that is fair to say.
Okay.
Thank you. Mr. Chairman, the most important thing in my report, a formal introduction of our new Deputy Director, Peggy McEwen. Peggy joins us from DEQ. She's already hit the ground running, found all of the errors I made prior to her getting here. And we are
Already?
I doubt it.
I did the minutes myself. But Peggy has been a great addition to the team, and please feel free to use her as necessary. She's got it all under control.
Welcome. So with that and the earlier action by the confirming the Personnel Committee's work, our Executive Director is back to only having one job. It's probably appropriate at this time to say thank you very much. What you walked into or inherited or whatever due to an odd sequence of events that had nothing to do with you or with us for that matter. Just, retirements and then somebody getting a better job and that kind of thing was a little daunting. And I guess I never appreciated how daunting it was until we were discussing, what we did in the Personnel Committee, and then it really dawned on me. And I think part of that's because of the way you handled it. So, thank you. And, but don't think that we're gonna,
Oh,
we'll find a couple other things.
I've never had someone go in and say, oh, look, the revenue estimate's $80 million high either. Never had that problem.
So, anyway. Anything else from you?
Sir, no.
All right, then let's go to the STIP review. Kirsten, John, welcome.
Before you get started, how's the new boss?
We'll talk about it later.
All right. Good afternoon. We'll be talking about STIP today. I believe we're on tab 3. Correct. Great. Introduction, our tagline of STIP, safety first, liquidity second, and income third. I hope to say this enough that you will all have it memorized by maybe the next year or so. We're trying to preserve the principle of STIP while providing our participants with one-day liquidity and getting a high level of investment income while practicing prudent investment principles. In order to meet these strategic objectives, we must manage risk and provide liquidity. So we'll move on to page 3, talk about managing risk. STIP is a huge portfolio. It's almost $4.5 billion as of year end. We had over 1,000 transactions in the last calendar year, which was in excess of $27 billion. And that's not just the fixed income team. Our operations team has to approve all the trades. Our accounting team has to process all the trades. We work with a lot of people, so I should say thank you to all of them for all the help they give us during the day. On 12/31/19, the STIP reserve was 1.16% of the STIP balance, which, yay, great. One of the fundamental risks is what we refer to as breaking the buck. This would be that a STIP participant would not be able to redeem a share of STIP for $1, transact at $1. So we are always trying to avoid that. The STIP reserve is one way that if we run into trouble could help with this.
I know we talked a lot about that reserve, and we have some goals that it's supposed to be at a certain amount. Do you feel comfortable that the reserve is big enough?
Where it is right now, or where it's going?
Well, I guess really where it's going, but I mean, bad things can happen. We will blame you when they do, but
Yeah, right?
that's why
Won't
that
expect
reserve
otherwise.
is there.
Yeah.
But I know we need a reserve, but do you think it should be higher?
I think the direction we're going is the right direction. And I think that deciding what level that should be is above my pay grade in the end. I feel comfortable with all of the work John did when he was managing, deciding where that level should be. So there's my non-answer.
Question?
Well, I mean, let's get, she funded, whether or not she knew it or not, she funded the job.
Well, I would just add, Jack, that when we set that reserve level, we looked at the worst case in history and tried to set the reserve sufficient to cover that. And so you ask if we're comfortable. Well, intellectually we are. Emotionally, sometimes you still wake, and I'm sure Kirsten does still wake up at night and worry about, well, what if 3 companies went bad at the same time? Could we handle that one? Well, maybe not, but that might be a scenario that is too far in the tails there could be no amount of reserve that would cover that.
Is it 1.5? I can't remember what that number is. With the number, where we want to go to with the reserve.
So where we want to go is 1.15.
Oh,
But
1.15, yeah, okay.
and you'll notice we're slightly over that. But we're projecting that at the end of the year, we projected that STIP would continue to increase, and it has.
That's got the second question. Is that just cash then, so nothing bad can happen? I mean, what does it mean, that 1.15? Is it still invested like everything else?
It's invested in a 2A7 government fund, so backed by only U.S. Treasuries of bills.
And that's our money? I mean, that's what that
The
means,
STIP
right?
participants, yeah.
It's not allocated.
It's not your money, Jackie.
Only 1.15.
Yeah, 1.15 of, never.
So that's approximately $50 million in a government money market fund. No gates, no haircuts, treasury and
And we
agency.
can also buy treasuries in the STIP, but right now it's not. Doesn't make a lot of sense.
From a policy perspective, it's important to remember that the minimum you set as a goal is 1.15. You didn't write it as, this is the maximum. It was the minimum target you wanted to get to was 1.15. So we've just recently crossed that threshold, and for the most part, we crossed that threshold based on some secondary sales that filled the bucket up relatively quickly. So it's, you know, to maybe take the pressure off them. I'm not comfortable with 1.15. I think we've got some room to let that thing run a little bit more, and then we can have another conversation about it when we get a bit higher.
But so remind me, we've had conversations about at what point do we stop? And we've basically decided we're not there yet, right?
Correct.
Okay. All right.
So we'll talk about 4 different risks in STIP: credit risk, market risk, liquidity risk, interest rate risk, and how we manage them. Credit risk, this is the risk that an individual security or name in STIP will underperform. One default can make it hard to transact at $1, especially if we have our 3% limit in the name. We mitigate this risk by limiting exposure in our investment policy statement and only buying approved names that we discuss with risk management at least 2 times a year. That being said, things happen. An example of which is at the end of last year, Boeing was downgraded due to the problems they're having after the 2 737 MAX crashes. They were on our approved list. When they were downgraded, we had about 2.5% in the name. We currently have about 2.5% in the name, but 90 million of that, about 2%, will roll off before the end of the month. The other 20 million is out until November. So we are allowed to hold things that have the A2, P2 rating. We just can't buy any more Boeing, which I was asked just today if I would like some more.
So is that what you mean by laying awake at night? You lay awake at night hoping that all Boeing planes stay in the air?
Yes, absolutely.
Lots of reasons.
Yeah.
What's that?
There are lots of reasons.
Full disclosure, Kirsten's husband works for Boeing, so we're really hoping all that Boeing.
Yeah,
Oh, okay.
right, absolutely. Yeah, right, and that they aren't grounded too much longer. Just like to give you an example, as soon as it was downgraded, we took it off the list. We can't make changes that quickly if we become uncomfortable with the name. It's easy to take a name off the list, it's way harder to put one back on, because that involves the meeting with risk management and coordinating with operations. Do you have any questions about credit risk?
When you say you take it off the list, it means you two?
Usually me, but
So we've always had an agreement that anybody can take a name off the list. Anybody that sits in that meeting. So Kirsten could take it off the list, John obviously now. But it says that the name be off the list, or I could say I'm not comfortable, and so
Buying more.
yeah, so we don't necessarily have to vote on that. We can just, not a matter of policy, but just an agreement we've always made that if somebody steps up and says that I'm not comfortable with this name, we take it off the list.
Okay, thank you.
and we're also not forced sellers, I'd like to point out. So if Boeing was downgraded, if we'd been forced to sell that 110 million rate when they were downgraded, it wouldn't have been a great time, especially year-end where the money markets are out of sorts. It would have been more difficult. We might have realized the loss on those.
So is it, I lost track of the numbers, is it 90 million that's coming up?
Before the end of the month.
So that will come back to us at 100%.
Yes, and hopefully the 20 million in November as well. Yes, of course, if Boeing has more problems, we'd probably look at selling that as well. All right, slide 5, market risk. This is, like it sounds, factors due to the overall performance of the financial markets, the diversification between asset types is the best way to mitigate this risk. As you can see in the chart below, we have a good mix between government agencies, asset-backed paper, and corporate names. We also have maturity caps. We can't go past 397 days in fixed rate securities or 2 years of floating rate securities. Asset-backed paper, we're only maxed out at 90 days. Do you have any questions about market risk? Liquidity risk. This is linked very closely to market risk. We don't want to force sales at unfavorable prices like I talked about earlier. What's unique to us in this is that the state agency money in STIP is stable. So most money market funds do not have that stable base of funds. So you can see even though we have local government participation where they put money into STIP and take money out, the chart below you can see it's pretty predictable. Again, we have a stable base. Also, April works closely with me. She'll let me know if a local government wants to sell a big piece of STIP. She gives me a heads up a day or two ahead of time so that we can make sure we have maturities and money market funds to match to that. Also working with all the investment teams when we're funding other investments. DOA will let us know too, and then of course there's payroll, pensions, and OPI payments that we know ahead of time. Any questions about liquidity risk?
I have a question. Are the spikes property tax
Yes.
collection?
Our agreements with local governments, do we require so much notice?
No, they go 1 day.
1 day?
Yeah. But as I have said, they usually do email April. Again, if they're, she's probably just working right now. If they are going to withdraw a large amount, they give her a courtesy heads up and she asks me and, I always say, yes, go ahead. We have plenty of liquidity, so it's good.
And Carl, when we've done some outreach with local governments, we try to ask them to let us know if they're going to withdraw a large amount of money. So we're trying to communicate that with them.
And I always have to ask this question, what does large amount mean?
Usually we tell them $5–10 million if they're going to take it out. But for a particular participant, a large amount could be $100,000. It just depends on the participant. So they'll let us know on sometimes smaller amounts.
And April usually lets me know if it's over 10 million.
Thank you.
Interest rate risk. This is, the risk that the portfolio value will decrease with movements in treasury rates. We have this chart below, which looks like there's a lot of volatility, but I'd like to point out the scale on this. It's a very small scale. This is less than 1 basis point positive and negative here, which is 1/100%. So although this looks huge, it is really small. And that's, we say the interest rate risk is usually less than the credit risk because the duration of the STIP assets is short. If it were, say, trust fund, it would be a different story. Now I'll hand it off to John to talk about STIP performance.
Just refer you to slide 8 and make a couple of comments on performance. You can see that performance in recent years has gone up, generally in line with movements by the Federal Reserve, increasing the effective funds rate. The return yield and return both are a function of the treasury rates, the short-term treasury rates plus risk premiums. So, but in recent years, driven far more by the effective funds rate than by a risk premium. So you can see that had gone up in recent years, and unfortunately, you can see that it's going down. We're projecting that to continue. Couple of things to think about in regards to the risk premium is that, as we've mentioned before, LIBOR, the London Interbank Offertory Rate, is going away. Right now, we believe that will be replaced by the Secured Overnight Financing rate, or SOFR. But a couple of things about SOFR is that it does not include a risk premium. So the market is still kind of finding its way around how to add a risk premium to that. And it is only in its infancy in regards to building a forward curve. In other words, a rate in excess of 1 day, in excess of overnight. And so we're just barely scratching the surface as to forward contracts there.
John, is that taking longer than you thought it was going to?
Oh, yeah. Yes, I would say that it started about on par, on pace with what I would have guessed. But we continue to see people issuing LIBOR securities even past the sunset of LIBOR. And assumably they built mechanisms into the covenants of the contracts to say what the rate will be, but it's surprising, if not shocking, that continues to happen. Any other questions on regards to performance? Just one other thing on slide 9 that we would point out is that STIP is used by the trust funds and the separate accounts, but it is not used by the pension funds. The pension funds use the State Street Short-Term Fund, that's what we call the STIP fund. That is not really a government fund, it's more what we would call a prime fund. In other words, it has other things in it besides treasuries and agencies. But it is for ease of transactions and for tactical, I should say, moves. Mike and the team use that instead of STIP. The one difference we would point out is that the fees are just slightly higher in STIP than they are in STIP.
So John, I would say we use both within the cash asset class. We have both STIP and STIF. We can move STIF a little quicker sometimes, so there's an amount of STIF there that we can move to asset classes more rapidly, but actually the majority of our cash asset class is in STIP because the fees are lower and we have control over what that is a little bit better in terms of what's in that portfolio.
So the pension funds do hold STIP?
They do. They hold both.
Oh, okay, they hold both.
Yes.
That was actually one of the first things that came out of cabinet was the coordination between fixed income and operations. Previously, we had the majority of the money in STIF with only a small portion in STIP. John stepped forward and said, well, why are we holding more money in the lower yielding, higher cost? So we took about 3 months to switch it over. So now we're holding the majority of the cash cap in STIF instead of STIF. We still have a STIF holding because it is instantaneous liquidity, whereas STIF is an overnight liquidity.
Any other questions? Oh, we talked about that before. Put it in before your conclusion, I apologize.
That's okay. We just want to give you comfort that we're always thinking about measuring and managing the risk in SIP. And then after determining the appropriate amount of risk, maximizing income. And now we'd like to show you the Bluebird.
Oh, are you going to do one? Huh?
Yes.
We're going to buy 100 million.
We're going to buy some voting right now.
We can show you what happened if I try.
on CFA in December, so congratulations. We're working on level 2 now for June. Quick turnaround.
Is that right? That's work.
Yeah, is that like, not like,
Sure.
Good job. That's the one we want. That's wrong.
That works. That good?
Yeah.
First thing I look at when I should say log in on the morning, since I do this from home, is BT&M. It's our money market screen, what's going on with the market I trade in. You'll see over here, here's the SOFR rate as of 6:15 this morning, 158 for last night. They have the commercial paper here, you can see very flat. If you buy 30-day paper or 90-day paper, you're probably getting the same rate right now. LIBOR over here, you can see a little bit of a disconnect here between the commercial paper, because if you were to go up 3 months, you do get a little bit of a pickup from the 1 month here. They also have the T-bills listed here. You can see it inverts at the 1 year, so what does that mean? Well, we'll show you in a little bit. Next, we don't trade in a vacuum. We need to know what's going on in the other markets. So the equity index, oh, looks good today, lots of green. Should make you happy. Something I like to point out here, we know what's going on here when there's stress in the equity markets. There'll be, a rush to safety at times, and then treasuries get more expensive. So now
What's number 2? The heading?
right here, S&P.
No, the second down under the F. The second, yeah, that word.
Oh, emerging market.
Oh, okay.
Or your
What's up, Mark?
maybe. Yeah.
Yeah.
Here in Africa, Middle East.
And then our trade screen is called Boom. You can see here we've sorted by our approved list. You can see here is the rate we're getting on this paper. You can also sort by days. If I'm trying to fill a day that, say, John buys a $45 million mortgage that settles in a week and I need some cash there, I can sort and find some 7-day paper to settle on that day. We can also sort by name. Sometimes there's not a lot out here, especially at year end, and maybe I don't have a lot of room in names since we have a 3% max, and that can be helpful as well. In our CMGR screen, this is where Tim has put all of our portfolio restrictions in. These aren't just STIP, but these are all the portfolios in general. I type in 3% so that I can check and see where we're at in certain names when I'm trading in the morning. Maybe I want to run it a little close to the 3%, and this is handy because it'll show us exactly.
Are those the names that you are at 3%?
So here is where we are. So ISF, we have 2.8%, so that's the closest to 3 we have. So I could buy $8 million right now and not breach that.
Can you scroll down to see how small your holdings get? Okay, thanks.
And so Apple at year end probably just bought a day to fill it because they were out there, and their rates are probably right on top of agencies, so I'll probably buy an agency before I buy Apple. So yeah, again, thank you, Tim, for putting all this in here so that it makes my job easier in the morning. Our BDS screen, this shows our portfolio in real time. So as I'm trading in the morning, I can sort by our allocation, our asset type allocation. I have a 40% max in asset-backed commercial paper. And so I can sort by here to see how close I'm getting to that. Right now it's, you know, a little under 33%, so I would be fine to keep buying that, but sometimes I'm closer to 30 or 39, so it's nice to have the real time here as it's going through. Next, talk a little bit more.
You've showed us this before, but if you try and buy more than that, what happens?
We can show you right now.
But I don't, if you're gonna show later, I don't.
Oh, no, that's fine. I don't mind skipping around.
By Anglesey?
Sure. So Anglesea's a name that I'm sure I'm very close to pull in.
Don't buy it, John.
It's more a guideline than
Tim's not that mean.
Right.
So one thing, I'm sorry, go ahead.
Oh, no, go ahead. So we could check compliance here, and then it'll say,
Tim says?
no,
No.
yes. But
So what does that mean? Will it not,
it won't.
it won't allow you to do it?
Correct. And then we can go here, we can also submit it, if say I'm in a hurry and I forgot to check compliance and I think I'm fine, and it still won't let me buy it. If you have to check compliance before you send it through.
So is that something Tim set up, or is that part of Bloomberg?
It's part of Bloomberg. Tim set all the rules in there for us based on our policy statements. Yeah,
Can you get around it?
No.
not that.
There'll be times when I won't say it's in error, but there'll be a question as to what the exact wording of it. For instance, if we have fixed to float security,
Yeah.
it will reject automatically, and then we might go in and talk to Tim and say, well, okay, but this is a 6-month, a 2-year security, 6-month fixed, 18 months floater, so it should go, and if he agrees, then he'll let it through.
Along with CMGR, there's a feature called VMGR, Violation Manager. So if they do that, if they do actually try to push something through, then it's got to go to the next level, and somebody else has to approve that before it actually is filed. So it would take 2 people in cahoots to buy something you're not supposed to.
And who's the second person? You?
Me or Mike, yeah.
A lot of times you'll see false, false positives, I guess you would say, where it trips something where the system and the rules thinks it's in violation, but then that's when you have the discussion to say, why is it in violation?
The fixed to float is a great example of that, but it starts out as a fixed security, and there's a rule against buying that over a certain maturity.
Right.
So the machine doesn't know that. It's going to change to a floating security after 6 months. So we've got to make the human call and say, okay, this makes sense. It does fall within our guidelines. There's just no way to make the rule in Bloomberg. So we try to do it as conservatively as possible so that it will trip and we will know about it, rather than it just saying, okay, we can have a fixed maturity that can go past that. We've got to have something in there that a red flag goes up and we can look at it and say, yes, no.
How often do they bug you with stuff like that?
Every time a policy changes, every time you guys vote on something and change anything in there about the parameters of what they can buy or sell, we have to go in and change something. Those guys bugging me is not very often. It used to be in the beginning. it was more often, but as I refine how Bloomberg is looking at things, as we see, you know, the gaps or whatever that can come up, then we can refine how the rule looks at things, and it tightens it up pretty good.
Yeah, correct.
How do you document the request and approval?
I don't, Bloomberg does. There's we can get a report that will tell us, okay, what happened on this date. We can run audits on it. We can look daily. John was about to pull up BMGR. I'm not sure if you can.
Oh, yeah, I don't think I can.
I think you have a view-only look at it. But it
Do
will
we have some system say, okay, I approve that on
Yes.
the 11th?
Yes, it will have my digital signature on it, because I have to sign into my thing with a fingerprint. It's biometric. It's really locked down more than you would even think of.
So earlier, Kristen showed us the screen that showed where they were in comparison to the maps that they were allowed. So when you make an exception, then will that screen show that you're over the maps
Yes.
on that?
Yes, it will show red. It will, you can click on any report, like when we were in CMGR. You can click on any report and look at a single rule and see where we are in comparison to that rule. If it's red, then it shows up and a signal goes out, a message is sent through Bloomberg to everybody in the system. You hear a ding and they say, oh, what's going on, you know, what are you trying to do?
Yeah, I hear Tim go, what was that?
So is that why Kristen's got the radio in her garage?
That's not the violation you're looking for.
So if there's a disagreement as to whether something is allowed or not, that can be something we discuss in the future, but Tim gets to say.
Well, I don't just, when fixed to float comes in sometimes, that's the one that gets me the most. I'll say, what are you guys doing? And they'll say, well, and they show me the screen where it says this will change to a floating rate over after 6 months. And we're 2 or 3 doors apart, so I can hear them whisper.
Secrets, I know. I guess a couple.
It's like living with mom.
That's the idea.
We took you way off script.
Okay. Our work screen, this shows us the effective Fed funds rate that John was mentioning earlier. You'll see here, as I was saying, that Treasury 1-year yield is because they're expecting a cut. The market is expecting a cut by the end of the year, about 80%. So this is why, the Treasuries look the way they do here. This, since the coronavirus started, has been ticking up every day. I want to say it was, you can see here, it was, beginning of the year was kind of high, it dropped back down, things back up. And then I always compare this to the dock screen.
Sorry, that's me.
Think about those little arrows you want to get on.
Right.
So here you can see what the Fed is actually saying, what the numbers of the Fed are saying here. Here's the effective funds rates down here, and here's where they were printed. The effective funds rate, that's real time, updated throughout the day. This is, I want to say once a quarter, the dots are updated, so maybe a little outdated. So we can take this and go to our fixed screen. This is our fixed income trading. Right. here today. And under bills, this is where I'm buying treasuries most of the time for our portfolio. Again, you'll see it's very flat. You're not getting much from going out from 1 month, 2 months, 3 months, up to a year. That's when they start dropping.
Are you buying those from a broker or from U.S. Treasury?
From a broker. The only auction that we've participated in since I've been here by direct is the Treasury floaters. And those are a little bit different process, but we still have to work through a broker to get into the auction. I just don't think they get anything from that other than helping us out.
And how do you pick the broker?
I will show you. We can buy a treasury right now since we're here. I looked before I came in here. This 470 is a decent level, so we'll buy 20 million to show you how this process goes.
Why not?
Yeah, right? Well, I usually buy in checks of 40 million, but I already have something maturing on that day, so I'm only going to do 20.
So bonds are in 1,000, so we'll put in 20,000 bonds for $20 million.
Get that right.
There's things out there too that will make sure you've got limits on the amount of par you can buy. So if you want to buy more than 50 million, you have to split it into different, 2 different transactions.
So you send it over to the desk.
Yeah, so we send it to the desk, and of course we're the desk, which we've talked about before. So we go into our T-Box here. And then we are able to send it here to put it out to different brokers.
So now you just let the brokers know that you want to buy it, right?
So we can pick 5. Usually this doesn't need the check marks here. We can just check the top 5 here and send it out and say, give me your best price.
Now, why are they the top 5?
That either they have some on hand,
But they're posting it at the highest yield as well.
Yeah.
Oh, so yield, the top 5 with the top 5 yield? or
That's
top
a
five?
net yield to us?
Yes.
Less,
So it's not like we've chosen the top 5 and we only buy from them. This shows the top.
So this will show all the brokers that we are set up with on Bloomberg to sell treasuries with.
And how did we develop that list?
We have an approved list of brokers for all of our trading. And they have to meet certain criteria, such as assets under management. And I guess John have done that a lot more than we all.
So, I mean, we're looking for access to the market, and then, of course, efficient execution.
Right.
And so as you would expect, we have most of the major brokers on there. We have a few brokers that might be considered maybe second tier or regional if they have some sort of expertise. For instance, Cantor Fitzgerald or FTN has some expertise in mortgages and asset-backed. And so you know, we have new brokers come in at us every second of every day.
That's what I assumed, so.
And so, you know, occasionally we'll say, okay, well, I've heard of that outfit before, I'll kind of keep an eye on it. If we see that they actually are posting some decent offerings, then we might say, okay, well, you know, start sending me all your runs. And if we follow
What does that mean, send me where?
where they list, I'm trading this, or I'm buying that,
Oh.
or we've got this in inventory. We call that all runs. And if we observe from that yeah, okay, they actually have some product that we would buy at what looks like good prices, then we would follow up and say, okay, well, we're gonna go look at their SEC filings and make sure there's no warrants on this company, and then if we like it, we present it to Dan and team and say, well, here's the SEC documents, here's a link to the documents. We let them, you know, we confirm that themselves. And then Dan wants to know, okay, well, why, how did we become aware of
This
this?
is
Why do we
Dan
want
Zarling.
to? I'm sorry?
Dan Zarling.
Dan Zarling and team. And so we'll send an email saying, hey, here's the history of how we came to ask to add this broker.
Do you ever take losses? Do we have
Yes.
losses?
Yeah,
Based on kind of the same type of?
right, yes, just, we don't do much business with them anymore, they're not adding any value. It isn't a huge thing to keep them on the list, but at a certain point, you want to tidy it up a little bit.
Well, what about it? And then do you review it periodically to make sure there's no warts, no new warts or something like that?
So we do link to the SEC website that where they put out their quarterly and annual reports. We don't go and look at those reports regularly. Instead, we believe that the SEC will make us aware if there's a Wells notice or a notice that they would be under probation or something. So that becomes well known in the market. So that's how we would know if there's a problem. But we would be unlikely to ferret that out from an SEC filing in advance of the SEC itself or the market in general.
So keep in mind that all trades that we do, it's a payment versus delivery setup. So in other words, we buy this bond, the next day, we exchange the security and the cash at the same time. So we don't really have risk, I guess, if you will, to the fact that, maybe they don't deliver, I guess. Which, the only time that's ever happened, I think we had one Lehman crisis. But there's not really a lot of exposure there to the broker dealer in that sense, because we haven't given them any cash until we get a security back from them, or vice versa, obviously.
What about the flip side of that, not necessarily risk, but again, hypothetically speaking, somebody saying, oh, well, I like those people, so I'm just only going to work through them, when they should be working through a broader group.
So, this is one of the things we set up, I believe, since I was director of fixed income, was to trade treasuries electronically, because it did used to be, let's say we bought a corporate and we're going to sell a treasury, and we would maybe do it just through that same broker. We don't do that anymore. We would always do it this way, so we've got at least 5 in competition. And frankly, in the treasury market, you'll see when they click the button, everybody's going to be practically on top of each other in terms of pricing, because the treasury market is so liquid. When we get outside of that, then, we're trading through market access, or we're going to multiple dealers whenever possible. We can't always do it that way, but anytime we can put broker dealers in competition, we're going to.
Good.
All right, we're happy with those.
We're going to buy something here or what?
Yeah. Tell us what that's telling us. It looks like you've got 5 offers there and the ask price.
So these are, these are indications. This doesn't, until we submit, we don't have a contract to buy and sell. So we're looking at this to say, well, we think these guys are the best because they're posting better levels.
Now what's better, show me what's better.
Right, yeah. So you can see they're all the same.
So what we want is this highest ask yield. Why some of this doesn't populate, I don't know, but the discount is equivalent to the ask yield. And so we're looking for the highest ones there. And we're not going to, for the purposes of this, we're not going to put Daiwa and FTN in the mix because they will not come back to us in time. But
You just know that?
What do you mean?
Because it's different time zone?
No, because our experience is they post but do not come back. And it is a very short time frame that we're going to hit this in as short as 3 seconds.
And when you say they're long, what does that mean? 10 seconds?
Well, you know, you can't, at least that, but it's difficult to sit around and test that because the dealer will post a level for 3 seconds and then repost or maybe not repost. And so you kind of have to wait for all the options to populate and hope you can hit the right one in 3 seconds. And so I haven't ever actually tested to see how long they would wait.
When I read about high-frequency traders, how do they beat the system?
Well, they've got AI that and hardware like you wouldn't believe. So that's a whole different breed of cat than what we're doing.
So we're not worried about that.
They're going to beat us, no matter what, on very, very small fluctuations.
So John, why would you put those two on there if you know you're not gonna?
Because it populates our approved list of dealers automatically.
Oh.
Yeah, so we might try to corporate with them.
So it's not as if we've never traded.
Okay. It's a type.
So Bloomberg doesn't do everything for you, you have to have your job. Is that what you're telling me, John?
Right. We're important parts of this.
Oh, okay. Let me get that down. You want to repeat that?
Push the button.
Are we good with those, Kirsten?
Yeah, well, yes.
Take out. And we did.
All right, and look at that, 0.002.
0.2%.
Yep.
Woohoo!
Yeah.
Job well done.
So then we would say, hey, Tim, we bought a treasury.
Yeah.
And it still has to be approved by Tim. We print out a ticket and give it to Kelsey. Sign it and give it to Kelsey.
So that's it, you bought it?
We bought it, we own it.
That Jim hasn't approved it yet.
Well, Tim, are you going to approve that treasury?
Right.
He says he will.
Okay, so if he does, here's my question. If he
That's an
does-
ugly little truth of the matter
Yeah,
is we probably
I sign
contractually
them all
own this.
electronically with a PDF writer,
Wait a
and
minute.
so I can send them to Kelsey before I even come into the office.
Okay, so my question was that Tim doesn't, you bought this, but
Yes.
Tim still needs to approve it.
Right,
But you bought it,
yes.
so what, does it come out of your salary?
Yeah, it's going to be a lean year at the
It's gonna be
Vermont. So we would have to ask if there was an honest mistake, then the brokers would break the trade. That's just a gentle person's agreement on the street that if you make an honest mistake, that will break a trade.
Do they have to approve it within a certain amount of time?
Well, this settles tomorrow.
Tomorrow?
And so, yeah, by 1:30 tomorrow, we better all be in agreement.
Most of the trades are same day.
But if it were out of compliance, it wouldn't have gone through, right?
Correct.
Okay, so then, and you worked, so you bought off the approved list, right? And you bought from the approved broker,
Right.
and you're not over the, you're not out of compliance,
Right.
right? So what would Tim not approve?
Well, I don't think he would not approve anything.
Okay.
We would have seen that, Carl, when we sent it to the banks. That's
Right.
when the compliance on this trade happened.
Okay.
And so that's why we're comfortable going, using a process that is that quick.
Okay.
Oh, I know you buy accounting donuts. You buy Tim donuts?
Well, Tim and I are off the sugar. Yeah. But I say sorry, Tim.
He tells me stories.
Can you buy my salad?
So,
That's not friendship.
so then is Tim's physical approval, is that a record keeping thing then?
Yes,
Is that what it is?
yeah.
Carl, it's also addressed in our internal controls. It's a segregation of duties, right? And you're pointing out that it's all there electronically.
It's already been done.
But
so
we
that's-
say in our internal control policy, we'll have an investment staff make the trade and operations will approve it, so.
And it feels like Bloomberg will let us do it too. John cannot do a trade and approve himself. There's a separation of duties in Bloomberg, not just on a piece of paper. It's actual physical separation of duties where it's impossible for him to approve his own trade.
So there's an electronic approval you have to do.
Yes, sir.
And you can print a log that shows what anybody did in the process, from executing the trade to approving the trade. When Tim goes in and does his piece, it's actually transmitting the trade to State Street as the custodian. We get various statuses as to where that is, whether they've accepted it, acknowledged the trade, et cetera. And then at that point, they hand the ticket over to Kelsey, and Kelsey then works with State Street to make sure everybody sees the trade and then the settlement occurs.
There's a really extensive, what Mike's talking about, audit feature in Bloomberg as well. That it's every tick, every action that's been, yeah, it is recorded, set up, they keep it for 7 years. Yeah.
Yeah, so I understand here, at this point, physically, what do you have to do, Tim, with that? Do you do something in, that's the Bloomberg system, or do you do something with a pen and piece of paper? What
I have to log in at using my biometrically secured device, which means my fingerprint in this case. I've got to have a terminal, I've got to have permission to TC. I can't have permission to TC and trade at the same time. So what I've got to go in is exactly the same terminal, a Bloomberg terminal, I guess not his terminal, but and then I've got to go to a screen called TC. I will see that actual trade, and then I will have to approve of it. First, what I do is I look it up, make sure it falls optically within the parameters, like minimum security rating, maturities, things like that. Things I know that the machine has already checked it for, but just out of, is that a TC screen?
Yeah, and obviously I can't send this.
So if he were to right-click on that Cedar Springs, maybe it, yeah, right-click on that. You can go to the audit trail. And if it was a, we should maybe go to the, you can't even get that one. Okay. So it's
Good
in
use
the
of segregation of duties.
Exactly.
So,
Right, I get it.
Yeah, so the fact that that came up red because he clicked on it, that, we should take that as a good sign, right?
Yeah, he can trade and approve.
Yeah.
Can you right-click on the not, see, well, on that, the bill, the B040720 is the one that he just did. On mine, it's got a feature on there that says send to custodian. Send a trade feed, I guess is what it's called. So that's where I would be able to approve it and send it to the custodian as part of the process. And you can't do one, but description is another one that I look at. View details is the actual ticket. It just things that he can't do on some of these things. But yeah, you can look at a ticket. So this is what the ticket itself looks like that gets sent to accounting. It's got all the details of the maturity, how much, what account it's for, buy or sell, when it settles.
So Tim, my elementary understanding is that the machine won't let him do certain things. But if the machine allows him to do that, then you really go back and manually check it to make, is that right?
Well, that's part of the process is me manually checking.
Right.
Yeah, he can't,
I mean, you know that he couldn't have gotten that far if he was out of compliance with it, right?
right, he couldn't have gotten that far, it would have sent out a ding across everybody's terminal.
Right.
It wouldn't get sent to the custodian, so there's a clearinghouse for corporates, DTC, for Fed, or governments, it's the Fed. So like he was saying, cash versus payment, or payment versus asset, I guess. They've got to come together at the same time. If they don't, if only part of it makes it there, the cash or the bond, then it doesn't settle, which means it doesn't go through to the custodian, the cash, it doesn't change hands.
We're getting behind.
Well, so is you and Mike have to do this? I mean, what happens if you take a day off?
Yeah.
Well, so
Tim does this primarily, and then,
Are you back?
I back up Tim when he's out, and that's when the false positives hit, and I gotta figure out, how do I clear this violation? I have to call Tim on. Yeah, there's the segregation of duty, so they can only trade, but they can't approve. We can only approve, but we can't trade.
But also risks management backs up
Yeah.
Also,
So the
compliance.
fail-safes we've got are ops and risk management, and then within accounting, Paul A. or Frank and their respective teams. So there's
I was thinking you really have to
multiple, and
coordinate
then
vacations
the
and time off.
and the big thing is, all of this falls within the SOC audit that you get done. So all of these rules, transactions, policies, Whipfly comes in, and we've gotten 2 years of clean audits on, so.
Well done.
Do you have your B in it, Joe?
I do.
Can you show them? So I can be sitting at home. When the power went out that one day here in Helena, I was approving trades from my home. Because I just have to have somewhere where I can go in using this mechanism that John has. It's a small credit card size thing called the BIO. It's the same thing. I've got to actually use my fingerprint to get on.
So this is the B unit. We swipe our fingerprint. It flashes a code to the screen. Or I should say the screen flashes a code to it, populates the code, we type that code in, and then we can get in remotely.
So Bloomberg makes a lot of money on that.
Oh.
So we're kind of stuck with them, right? I mean,
Yeah, it would be a difficult to imagine a different trading system at this point.
And he knows it.
And how?
All right, well, let's, yeah, thank you.
Thanks, guys.
It's amazing. It's really amazing.
How much fun is that?
John? John? Tab 4, John?
Tab 4,
Okay.
policy statement stuff.
Oh, boy.
So several memos here, but the first one, we've got some proposed changes to the STIP policy. Really just kind of some cleanup things here for the most part. So section 6, page 4, we just had a sentence there that no longer comports with how we treat this on our financial statements per our consultant, per what Julie tells me. So striking that, and then as we talked about a little bit before, changing the ratings language to the NRSRO language within STIP.
You want to do, we're going to do them one by one? Is that the easiest?
Sure.
Okay.
Easiest.
Any questions on changes to the STIP investment policy? If not, is there a motion to approve?
So moved.
Is Is there a second?
Second.
Any further discussion? If not, all in favor say aye. Aye. Any opposed? Next.
The next four will be accounts that the DEQ, the Department of Environmental Quality, DEQ, would like to begin investing funds long-term. These funds have all been around for many years. The reason that we're bringing them now is that they are able to project with some reasonable certainty future expenditures so that we are comfortable that they can be invested in trust fund or other securities. We want to do.
So we have the, so where, was Barker Hughesville?
Barker Hughesville is the first one.
And can we do all four at once, you think?
Yep.
All right. So we've got Barker Hughesdale, Flying J Circula, with the asbestos, and the Luttrell pit. Is that right?
I think they call it
What?
Luttrell.
Luttrell pit.
Peggy, you were from there, how do they say?
Luttrell. Okay, pit. Changes. Is there a motion to accept the changes? Oh, these are creations?
These are all new.
Oh, these are all new, that's what I was wondering. Okay,
I would make that motion.
to accept these new.
Proposed IPS.
Okay, is there a second?
Where do those, Carl?
Yes.
Where do those changes go?
Where do they go? Well, they're not changes, they're new ones, and they are immediately behind the state short-term investment pool changes in tab 4.
They would be part of the separate accounts policy, Mark, if that's what you're asking.
And they're part of this.
I'm just looking for that.
We didn't include the whole separate accounts policy.
Right.
So each would be a separate appendix.
Got it. I understand now, I'm sorry. So we have a motion to approve them and a second. Any further discussion? If not, all in favor say aye. Aye. Any opposed? None? Moving on to the,
So the trust fund investment policy, the memo here you see before you. So maybe just a little bit of color here about how we got to this recommendation to change trust fund policy. So as we look at trust fund, I mean, as you know, currently we're probably 80 to 90% investment grade fixed income. We know where rates have gone and how low yields have become within the investment grade space. So as we looked at that and said, well, if we were to create the trust fund investment pool today, would we be 80 to 90% investment grade bonds? And I think the answer was pretty clearly no. And we're limited, of course, we can't invest in equities within trust funds. And so looking outside of that, well, what else would provide us a appropriate return for those participants? Because most of the participants there are very long-term, if not perpetual. A lot of them cannot spend their principal. They just get their earnings, and those earnings support whatever program that they may be invested in. And so what would get us that stable income stream without a great deal of volatility, something that looks kind of bond-like in some ways, and real estate tends to fit that bill. So if we were to look at RBK's asset allocation in September, and we looked through that and said, well, you know, what does real estate look like? It's got a little bit better projected return over the next 10 plus years, as Jim said. I think it was, what, 6% versus 3 3/4. It's got the lowest standard deviation, so the lowest volatility relative to any other asset class in there, with the exception of investment grade fixed income or cash. Cash isn't going to provide us much of a return. So we think it's very logical to increase our allocation there. We also have experience with real estate. We're very comfortable with the asset class. We've got a team that's got deep experience there. We are not really concerned about the illiquidity that real estate would add to that pool because, again, most of those participants are relatively static. That the amount that's in trust fund does not tend to change dramatically from year to year. And finally, kind of as we thought about real estate and probably more specifically, the majority of what we would want to add here would probably be in the core real estate vein. When we look at core real estate, the one thing it kind of has that we don't have in the pool right now is that there's an equity-like component to it, if you will. So we can buy into that core real estate pool and we get those steady returns from rents and leases, but we also get to enjoy the appreciation of those buildings that happen over time, which tends to grow that rent and lease payments that we're getting over time. Whereas in the bond portfolio, we're continually maturing and investing at lower rates and lower rates. Obviously, if rates go back up, we get to invest at higher rates, but that certainly hasn't been the trend and isn't really what we think is going to happen, at least in the near to intermediate term at any rate. So all those things said, we felt like asking for a much larger allocation here, and we realized that it's a big ask to go from 8 to 30 within real estate, but we think that's appropriate. And I would also say that this is not a, you're going to vote give us 30% range. This is probably a 3 to 5 year project to get towards the upper end of that range. That would be the goal over time, but it isn't going to happen right away. I think 3 years is probably what we would be shooting at, but maybe it takes us longer. So, it will be a slow process. And then finally, I guess I would say we did have a couple of different calls with RBK over this. They raised a number of very good issues. Of course, as they look at it too, they're like, whoa, you're going from 8 to 30. What's the reasoning here? I think we talked that through. I think they understand where we're coming from and hopefully agree, but I will let Jim talk for himself on that. And then they suggested, well, how come you're not going to a greater allocation, let's say, in converts and preferreds or other things that we may consider. All very good points. I think we did add in here that, changing high yield to non-core fixed income, just like we did with pensions, kind of opening the door to converts and preferreds and EMD. But we didn't change the allocation there. And frankly, I think at least at this point, we will consider those things. We are probably likely to go there, but I wouldn't be comfortable going with a big allocation to something like that now because we don't have the experience. We don't have those even in the pension funds at this point. All good discussions we'll probably have in the future, and perhaps we come back and ask for more latitude somewhere else. But for now, I think this was plenty and a big ask in and of itself. So maybe I'll let Jim comment on their thoughts on what we're proposing here at any rate.
Yeah, I think John characterized the conversations with us very, very well. When we saw it, we met as a team. Internally, we talked about it, and then we had at least 2 conversations with the staff. And from the perspective of the we work for the board add-on, this is an area where historically, our general tendency historically that has been potentially risky, and I say small r in that, because this is essentially a reach for yield in a very low environment. And that always is a tempting problem. It's a tempting problem in fixed income generally. But the yields are low, and John is correct that this is a fact, and it doesn't look like they're going to change anytime soon. Could be wrong about that. So to get additional return into the trust fund, the issue is where do you go? And we think the staff has been correct. We mentioned a number of other areas, but those are all areas where the staff's experience is very modest or almost not much at all. Whereas in real estate, John is correct that this is an area where you've been in for a number of years. And you also know have good knowledge of the difference between income-oriented, therefore less volatile, real estate versus private real estate. You know, you have deep experience there. I think that on the two things that the board should be aware of is, one, this interjects some equity beta, because real estate does have some equity beta into the trust fund portfolio, but not a great deal. If you look at the correlation between real estate and equity, it's far from one, so that's a good thing. And it is one of the few things that can potentially add some additional return to the trust fund, which obviously the fixed income market is not doing these days. So that's the thing to keep an eye on. And one of the things that we might do is track the equity beta of the trust fund, actually. It should be very low, and by definition it should be very low, just like we track the equity beta. And equity beta, just to remind everybody, is the sensitivity of the fund to the stock market, particularly the US stock market. So that might be a risk monitoring device that could be useful. On the good side, we agree that this is a 3+ year project. And that's a good thing from the board's perspective, because you'll be able to observe the effects on the trust fund without having to make a all or nothing, let's just buy 30% of the trust fund in real estate and be done with it. So, you know, after some conversations with your staff and with these comments to you, we're supportive of this.
Question? Yes, go ahead.
Bruce?
No.
Hi. Somebody asked the question.
All right, how about, have you discussed this with the participants? Have you got any feedback from them?
We have not discussed it with participants. They are generally only interested in what's the income that we're going to get each year. And I would say there is a wide disparity between, you know, interest levels of participants, the vast majority having almost no interest really. I mean, other than what they really want to know is they want to know what are, you know, what are you guys projecting for income the next year when they get to doing their budgets at the end of the year. I think we mentioned before, we're talking about having a meeting in kind of May, June to set that table. What they have been concerned about and what, you know, part of this relates to is how come my income keeps going down year over year? Well, that's where they're concerned, because they got a program to run, whatever it may be.
So I would just say, Jack, that we have talked in general terms with the largest participants, the DNRC School Trust Fund. We've let them know that we're working on things to increase the yield, and that real estate might be part of it, but not in any specific terms. But we've talked to them, and we've talked to some of the other participants in very general terms about what our thinking is.
Do all the participants' legal limits allow real estate?
They can invest in trust funds, so to the extent that it's available in the policy, yes.
So they own shares of the trust fund?
Right, but I mean, I can imagine.
And that already exists in the trust fund, real estate and core real estate already exists.
And no one's ever said, this is a problem for us, because this money is so restricted that it can only be in treasuries or something like that.
We've had some accounts that might have those types of restrictions, but it's been spelled out in the policy where we would, you know, we need you to ladder a treasury or something. But so that happens, but so that we probably wouldn't get. They probably wouldn't be in trust funds.
So that's a separately managed account.
Correct.
Okay.
So question. So this money is it's perpetuity. A lot of it is to produce.
Majority of it, yes.
And so when these funds, trust fund was founded, there was the wisdom that we want this invested only in fixed income, real estate, and STIP.
Yeah.
Those are the
well, originally only fixed income.
And I see then when we look at the state fund, we have about 12% of their money in equities now.
Because they have, they're the only other entity outside the pension funds that has the authority to invest in equities.
And how did they start with that authority?
No, it was a constitutional amendment.
Well then, haven't we just done a disservice
with our investment philosophy at the state on this money?
It's restricted by the Constitution.
Yeah.
The Constitution, that's, I looked it up.
So it's not the legislature?
No, it's section 13 of Article 8
Okay.
says which monies can be invested
The
in.
legislature tried to get it changed and presented it to the voters in
98?
Times haven't they?
Okay, I follow what you're saying. It just seems like a travesty, frankly. This is a third of what it could be, could produce.
You want to do a new initiative?
Well, it just seems though, I mean, we operate by the prudent man rule within the confines of the Constitution and the law, but as prudent men and women, this is silly.
If I could say, there are a number of western states that have created trust funds of various types, and a few eastern states too, that are income oriented, and the concept was only spend the income so that the corpus never goes away and is available for future generations. As you point out, there's a conflict between that and sort of the best investment for the corpus in its own right going forward. So there have been a number of changes in other states. Wyoming springs to mind, as does New Mexico. But you know, it's way above our pay grade to say you should change your constitution.
Yeah, I follow. But it seems like something that somebody should take on as a challenge in life. too.
All in favor, Jim?
said she wanted to be.
We have a new subcommittee.
You and I. He's no longer active as a legislator, so Fred's going to have some time on his hands.
I'll be right behind you.
Our version of the Rainbow Coalition. Who else? No one's going to touch this.
You're not asking the board today to present the concept and we vote on it next time, is that what?
We are asking for it today, but we went back and forth on that a little bit, but if you're not comfortable today, we can bring it back in.
If it's a, okay, anybody else? If it's a 3 or 4 year thing,
Yes.
why would we change the policy all at once?
So, thought about that, but in the interest of transparency, openness, et cetera, that Jack is very concerned about.
Right.
This is where we're going. If you want to give us 15% today and you want us to come back next year and the year after that and keep bumping it up, we can do that. But this is where we would be planning on going.
Is there a policy reason for doing it that way?
I mean, honestly, I don't think we can't get much more than a third in the ground, and the reason being is that trust fund, I mean, I guess we could, if we went out and wholesale just started selling or something. The concept is more, as things mature out of the portfolio currently, instead of reinvesting them in bonds, we will reinvest into core real estate on kind of a quarterly basis. Probably just sit down with Ethan and get a schedule together. We'll have some real estate probably outside of core, but the majority of it kind of being that quarterly draw for the core. So up to you how you want to see that. If you'd rather we come back to you periodically, that's fine.
No, I'm just curious if there was a policy reason for doing that.
Mr. Chairman, from my perspective, it's a bit like private investments in some of the other assets within CAP, where we set a, within the range, we're aspirationally going to get to higher electric. We know we're not going to get there overnight, but from a direction perspective, more real estate to counteract the diminishing yield within trust fund helps us in our conversations with the participants. Because having been on the other side of setting the budgets for these state agencies and trying to figure out how you're going to make a pay plan work, it would have been of great value to me knowing that the Board of Investments has a long-term plan, they're working toward it, and the diminishing yield is going to stabilize in the short term and in the out years, hopefully pick back up.
So I really like this. It's one thing, we are increasing our risk. But I think the long-range goal makes sense, and it goes to what Jim was just saying. It's sort of crazy to have all these funds that we're not maximizing some of the things we could do. And so I think it's great.
And is the restriction for core only?
Sorry, the real estate
Right.
range? No. So it's not
Right.
core only. The majority of it will be core, but there are some other vehicles that Ethan has that would be income oriented, some debt oriented type strategies that he is working on that might be appropriate as well.
All right, so now let me ask you this. How do we answer the question of Constitution prohibits, the intent of the Constitution was prohibit risky investments, prohibits us from buying stocks. And instead, you guys went out and bought a bunch of really crappy, high-risk real estate.
Right there. Yeah.
Well, no,
Ethan assured me.
No, seriously, no,
So, you know, I mean.
Opportunistic, sorry, I called it the wrong thing.
I think that we are more at risk almost on the other side of that equation to say, why are you so concentrated in investment grade fixed income? Why aren't you more diversified in your portfolio? I mean, so as Jim mentioned, you know, correlations between fixed income and real estate, almost zero. You know, yes, we're introducing a little bit more volatility here, but you've got, you know, most of this is going to be, as I said, core real estate, so you've got that class A properties. I mean, I think it's pretty reasonable to point anybody to the idea that, hey, instead of a bond, you own, you know, an Amazon warehouse, a skyscraper in New York, you know, Mall of America. Mall of America, the big one, nice one. You know, things like that that have that, you know, a steady return component to it. So we're not talking about putting, you know, 30% into value add or opportunistic type real estate strategies. That exists within our portfolio much
Sure it
more
does,
so
because
within
we have the
within
opportunity
pension.
to make a lot of money on it.
Sure, but that's the pension.
We also have
side.
the opportunity to lose a lot.
Correct, and we're cognizant of the idea that the participants, I don't believe, can handle a great deal of volatility here, and then that's not what has been prescribed, you know, a long time ago in the Constitution. So I don't want to ramp up risks to those kinds of levels.
Carl, I would say it's the exact opposite. I think knowing what we know, the prudent man has to make a decision like this.
John, a quick
I'm
question for you. Seems like in the policy, it's like, you need to be investment income oriented.
Right.
Is there a reason why you couldn't put in front of this, income oriented real estate class or something which would then include the debt type securities, but make it clear to folks you're not going out and buying real estate that's appreciation oriented or value add?
The problem is that's a spectrum. There's not a clear cutoff as there is in investment grade. Investment grade has a bright line. Income oriented, even most private real estate deals that are appreciation oriented still have some income associated with them, and eventually are supposed to. So I don't know that there's a way to do that isn't vague in and of itself. And I would say to the chairman's comment about the Constitution doesn't forbids risky investments. I didn't read it again like the chairman did, but I think it says no equities. Every investment is risky, including the ones that are in it today. They have credit risk, they have spread risk, they have duration risk.
Yeah, but that wasn't the intent. I mean, no one was talking about spread risk when we passed the 72 Constitution. It was that these were supposed to be safe, completely, I mean, as safe as you can get investments. And then the Constitution changed and allowed pension funds, right? That wasn't in the original.
I think pension was in the original.
And then, so then they allowed
State fund.
the state fund, and then there was an attempt to open up all the funds for equities, and it happened right after big downturn in the market, and there was a big downturn in the vote on that too. So, you know, I'm not arguing against it, I just want to know that we're thinking about this stuff. And so the next question I have, which I think is obvious, but have you got the capacity to be buying more?
Absolutely, we're constantly in the market, constantly investing, constantly reevaluating our existing relationships, constantly evaluating new deals as we look to further diversify the overall real estate portfolio. And John and I have been in discussions about opportunities, and we wouldn't underwrite an opportunity for the real estate asset class. What am I trying to say? We wouldn't look at a deal that wouldn't be appropriate for both investment entities.
But
But
these
they
will
might-
be
but
owned
they
by the
might-
trust, these will be owned by the trust funds.
Right, and so, but Ethan might have deals that he would put in pension funds.
Right.
That we wouldn't put here.
Right.
But we would be co-investing, if you will, trust fund and pension if it's appropriate for trust fund.
But the asset to be held separately.
Assets held separately, yes.
I think we should discuss private equity.
The private equity benchmarks.
Yeah.
Oh, okay.
When you're looking at the real estate investments, are you looking at the US, are you looking around the country? How will you select the ones appropriate to trust fund versus pension, for example? What will be that differentiation that you talked about?
So I think, you can correct me if I'm wrong, but most of the core real estate that we have would be US oriented. And I think that would probably be the vast majority of what we'd probably be looking at in trust fund. I don't believe we have a great deal of outside of the US, there's probably.
Yeah, we're less than 2% international. We wouldn't be looking at a China-focused fund that's putting 80% leverage on its deals to put in the trust fund. We would be North American-centric, highly stabilized, lowly levered, great tenant diversification, great credit across the tenant base, with very long-term, stable, durable income yields, with long-term leases in, main locations. In addition to what John mentioned, adding real estate debt, which just by virtue of where it is in the capital structure is less risky than real estate equity and has a arguably much higher income yield associated with it.
Thank you.
Did that answer your question?
You did.
Okay,
Yes.
great.
You're going to be looking for a real estate to put into the trust fund that's appropriate for the trust fund.
Amen.
Is there a motion? Or
To approve the proposed change in investment policy effective today.
I accept it.
Okay, any further discussion? If not, all in favor say aye. Aye. Any opposed? None. All right, and then we have the
So last one would be state fund.
State funds?
So for state fund, we are not asking for a vote today. So have proposed to state fund that we add the high yield asset class to their policy mix, 0 to 7% weight. Reason is somewhat similar, I guess, to trust fund. It's looking for a little bit of additional yield. They don't have any high yield in their portfolio currently. Not an ideal time for high yield in particular right now, so I, again, don't think we're going to rush out and, max out at 7%. We'll probably get a small bit there. The reasoning here, in addition to yield, is that when we have looked over the last several years at kind of the peer reviews that we get, State Fund gets some of these types of things, looking at their peers, the vast majority of their peers have an allocation to high yield. I think the average, when I was talking to them last, say 3% is probably the average allocation when you look at other funds of their nature. So would like to add that to them. I've had a lot of discussions with State Fund about this. worked with them, so one of the concerns there is, I can tell them, hey, I think we maybe should do this from an investment perspective, but I don't know what your regulator thinks about this. What does this do to your capital levels that they have to report to the regulator? They went through some metrics to make sure that that didn't have an undue impact on them there. They're still very comfortable with where they would be in terms of their regulatory capital levels if we had high yield in the portfolio. And so they're on board with that. We're on board with that. The only other change here is I would move their benchmark to the intermediate aggregate instead of the gov credit. I don't really know why it was the gov credit originally, but I mean, that goes back, I presume, since inception. On the back page, you can kind of see the difference between those two benchmarks. So the big thing is that there's no securitized within the gov credit. And so we've always had an ability to add mortgages in particular to state fund and asset backs and CMBS, and they've owned those in some way, shape, or form in the past. You've heard me talk about more recently that we've liked securitized a bit better than we've liked corporates, because corporates have been very expensive. And so this would just, I think, really be a better reflection of what they actually own at the end of the day. And I showed below that the return that we've seen over the last 1 to 20 year time frames, just to let you know that this is not an easier benchmark to beat. It's actually raising the bar a little bit, not a lot, but it's not about making it easier for us to beat returns, and we're comfortable that we can still provide value over and above that benchmark if we were to change that as well. And again, same type of discussions there. So the thought here was to put this before you today. Happy to answer any questions. We will go to the State Fund Board in March when they have their next meeting, present that to them so they get a chance to comment, make sure everybody's comfortable with it, come back to you in April and ask for final approval.
Would it help with them if we approved it now, or if the process you outlined is better?
Probably better to let them have a look at it first before we actually approve it.
Yeah.
If I could mention something here, I want to reiterate something that John said earlier, that this is less about investment risk from the point of view of this venue than it is making sure that the state fund has its ducks in a row and is comfortable with it with respect to regulatory risk. Because we do a lot of workers' comp plans across the United States, and all insurance companies have a separate examiner that has a different point of view about this than you would that's just strictly an investment point of view. So the risk mitigation and assessment is really, I think, on the state fund's side, not on your side. And the second thing is the type of risk is that there's asset liability risk, which again is not the purview of this room, but should be front and center on their table. And if John has had the conversations that he's had with them, presumably they've looked at their asset liability risk in terms of their actuaries' forecast of claims, and they've looked at their regulatory risk. And so the issue really is more from a risk assessment point of view on their side, I would think, not on your side. Is that, do you agree with that?
Yeah, that's fair.
Okay. Any questions? Okay. Is that it, or we have one more?
That's it.
All right. Let's break till 3. Okay. Thank you. All right, should we get back?
Take the chair down the desk, Steve? Yeah, I know.
Back to it.
It's his fault.
Ready? We on? Doug's here.
He's taking a gift.
Doug's here. We're good. Doug, yeah?
I'm ready.
Okay.
Whenever you are.
We're ready.
Good afternoon, Mr. Chairman, members of the board. We're on tab 5, which is the commercial and residential loan portfolios. As of January 2nd, 2020, the commercial portfolio balance was almost 167 million. It represents 106 loans. There's currently 4 loan reservations that total 16,700,000. 9 loan commitments, a little more than $56 million. The portfolio, excluding the Veterans Home Loan Program, has a yield of 3%.
That big 56, the one project and building, or Bozeman?
28 is the Springs project in Bozeman. But by the way, I went down there a couple weeks ago for the ribbon cutting ceremony. The building is pretty much complete. It's a beautiful building. They're way ahead of schedule on people coming in and taking rooms. So they're very pleased with how things are going so far. So we haven't participated with the Bank of Montana yet, but I'm projecting that it'll probably happen in March sometime. We'll be participating in that loan. The residential loan portfolio has a balance as of January 20th of a little over 3.2 million. That's 85 loans. The yield on that is 6.58. No outstanding reservations. There's really no activity in that other than pay downs at this point. There is one loan that's over 90 days past due. This is 2.6% of the portfolio. It does have an FHA guarantee on it. So the other portfolio is the Veterans Home Loan Mortgage portfolio. Has a balance as of January 20th of a little over 45 million. That's 260 loans. The yield on that portfolio is 1.88%. As of January 20th, there were 10 reservations totaling 1.9 million. The projected yield on those loans is at 1.7. And there is one loan over 90 days past due in the portfolio. And they just let me know as of January 31st, there's 1.1 million available out of the funds. So out of the 10 million that was allotted to the program on July 1st, they got 1.1 million left. So the money's gone very quickly on this program. So
Which program is this?
any questions?
Which program?
The Veterans Home Loan Program.
Yes.
Yeah.
I should know the answer, and I'm kind of embarrassed here, but so we have our cap side of the investments and our trust fund, and these returns are attached to
Colfax Trust Fund.
So they're on the trust fund side. Okay, so in a way, they're pretty good returns, I guess, on that side of the page, right?
You know, the commercial portfolio, a good return. The Veterans Home Loan portfolio, not as great a return on that. I don't know what the trust fund is returning on the investment side.
A little over 2 years to maturity right now.
Okay, thank you.
Okay. Anything else? Anything else for Doug?
Thank you.
All right. Oh my goodness. Good band.
Don't get too excited. I'm going to keep it short and sweet. Hopefully.
It's nice to see you there.
Oh, it's nice to see you. Thank you, Mr. Chairman. Good afternoon, board members. You guys are a little wily this afternoon. A little late in the day for that, so. All right, so we are under tab 6 for intercap bond program. This morning, our loan committee approved 2 loans for us, so thank you for that. I think everybody was there, so we kind of were all on the same page a little bit. And so the only thing that we haven't really gone over is the activity summary and the staff committed loans for the quarter ending December 31st of 2019. There were 3 loans committed from 2 repeat borrowers. So 2 loans went to City of Ronan and 1 loan to Macomb County.
Where's Macomb County?
Circle.
Whoa.
You know, we had to memorize all those things. Obviously.
I was just gonna say.
That's what, yeah, we had to know what, Tommy sees.
Are there any other questions, comments, concerns?
Why so few this quarter?
So I have my personal opinion about that. Do you want me to?
I will let you do
You want me to pretend to know things? Okay. So
Yeah, that's not the way to put it.
that's right. I do definitely know things. So my opinion on that is that's kind of a strange time of year.
Right.
It's the end of the year. There's a lot of holidays. There's a lot of people in and out and thinking, oh, we'll worry about that after New Year's. You hear that a lot. So I think that that's one of the biggest things. I think also, you know, we have a lot of repeat borrowers. A lot of people do know about us, and I think that they know our process of remarketing and our interest rate changes. And I think that they might be thinking, hopefully it'll go down. Maybe we'll wait and see what happens. So I think maybe that's what people are thinking at this point in time.
So could you talk about the remarketing process?
Dang it.
Predict rates or what, no, you don't have to do that, but just how that's.
We're right in the thick of it.
Actually, if I may, I can give some updates if I can come ahead. Thank you, Savannah.
For bringing it up.
Nice guesses. Nice guesses. She's doing great. I'm really proud of Savannah. She's coming along very well. With the comments about why we're slower, it's been really, the reason is because the short-term rates are looking about the same as like the 5-year rate or the 10-year rate. So people are really going to the banks, locking in fixed right now. So coming up with our let me get to my notes here. I was going to share all kinds of things during loan committee, but I wanted Jack to get out of this.
Thank you.
Yes, I did.
But see, now we gotta do
But
it
now you're
later.
here.
That's right.
It's on your watch.
But we'll try to be quick about it. So the bond rate, they gave us a minimum rate of 90 basis points. And the reason why they did that so low is because of that Fed rate cut that the market is trying to work in. Me personally, I'm thinking that it's going to be right up closer to in a treasury situation. Because when you look at treasury right now, the 7 days like a 143, a year you're sitting closer to the top end of 153, 160. And so as an investor, you might be looking at, well, if I'm going to lock in a year, do I do the bonds, the intercap bonds, or should I just do a treasury? So here's the deal, what happens with the intercap bonds is that when they're looking at pricing these out, they're looking at, first of all, the municipal market data. And the municipal market data right now for AAA-GO is 86 basis points. So still relatively low. They're looking at supply and demand. They're looking at, what else are they looking at? Other deals that are out there that are rated as much. Also the intercap bonds, because they are not a AAA-GO, they're just a little bit lower rating of that, and so you're going to see that in the rate that the investors are going to ask for that year back, for that situation. So we have, we do plan on redeeming early our Series 2000. It matures in 2025. We're going to redeem that a little bit earlier because I'm sure you recall that the University of Montana did do a large pay down because they took advantage of the low bond, and so they refinanced everything. And so that was $11.5 million. So with that, we're going to take one of our bond series out. The tenders, they tendered back about 77% of the bonds, which is normal. Everything usually gets pushed back out on the table. It's going to be a successful remarking, I'm sure of that. The tendered bonds is just under $70 million. So our credit enhancement, the funds that are designated for that, the treasurer's fund, and the 3 within the coal severance tax, they're running about $2 billion. So I'm pretty sure we got it covered. if they do get pushed back for some reason that we have to buy those bonds. There was some updates. Piper Jaffray had a merger. They merged with, Piper Jaffray is the remarketing agent. They merged with Sandler O'Neill and Partners. They are a leading financial services investment banking firm. And so now they're called Piper Sandler. And they added 300 employees to their organization. We went through our due diligence call with our remarketing agency. They range with the topics from general, taxes, legal, disclosure compliance, financial. And this year, new on the table, the question was cybersecurity. Investors out there are worried about who they're investing in and their cybersecurity. So we were able to answer all these questions satisfactorily for our remarketing agent, and they're excited to get our bonds out there. So we're looking for a successful remarketing. Now
Is there a
it's just
date
determining
when it's all going to be done?
Yes, yes. We'll have the final rate on our bonds February 24th. And then they'll also let us know if there's any other bonds that they haven't marketed yet at that time. This all closes. Once we get that rate, that's when we go to work on our side, is to put our spread on top of that for expenses and making sure that we pay our side. In the indenture, you probably already remember this, but in the indenture we have a maximum spread of 1.5. But we like to see if we can carve that down a little bit for our borrowers. So this will all close. Usually we close on March 1st. This year March 1st is on Sunday, so we will close on March 2nd.
So did University of Montana's refinancing, did that hurt?
Well, what it did, it gave us a lot of cash that when we have our projections out there, I'm sitting on too much money. And if reinvesting vehicles right now would be at least where I could get the same yield as I'm paying, that would be one thing. But I'm looking at the year ahead or two, and the rates are going to be under that. So that puts me in the negative for us, puts us in a negative arbitrage scenario. So it's, just to kind of peel that back a little bit. And we usually redeem those bonds 2 years before maturity anyway, because it's really, they kind of are too short to even worry about.
Anything else? Thank you, both.
Thank you.
All right, so next on our agenda is a discussion of litigation involving the board and the Public Employee Retirement Administration. So I think we'll close the meeting to the public for that purpose.
Yep. Yes.
Yes.
I've asked.
I turned it.
Are we on?
Picture was on the line, so I
Are we on?
said,
Dana, are we on? We're on?
does this sound
Yes.
right?
Okay, so let's go back
Hope so.
in session after discussion. And I think we have a motion.
Yes, Mr. Chairman, I'd like to make a motion to authorize Montana Board of Investments Council to file an amicus brief on behalf of the Montana Public Employees Retirement Board on case number OP 20-0063.
Okay. Is there a second?
I'll second.
Is there any discussion of the motion? If not, all in favor say aye.
Aye.
Any opposed?
Aye.
Okay, make sure. All right. That's done. I think that's the end of our business for today, so
Motion pass.
So was
the motion passed.
Mark opposed?
Yes, with Mark opposed.
No. I'm glad you're picking us.
No, I would not.
Mark was not opposed, that's what it. he was
Mark,
just
did
so
you
quick.
say aye or nay?
I said aye, we're good.
Oh, okay. All right, let's try this again. Yeah. So the motion passes unanimously.
Jack,
All
can I
right.
have that motion?
Yes.
Now we're adjourned.
Thank you.
And we'll see everybody at 8:30 a.m. tomorrow.
Is there gonna be a supper?
Yes.